Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
Well, we just got back from New York, the Big Apple. What'd you think?
Lots of people, lots of horns honking.
My wife loves New York.
Lots of walking, 8 to 12 miles a day.
If you like a lot of pollution, a lot of people, and a lot of trash everywhere.
But we had a good time.
No, we had a great time.
If you're from New York.
No, we had a great time.
Got to go to a play, Margaritaville.
Yep, I'm not doing that. But I've been to a few plays before when I was younger. Now that I'm older and crotchety, I don't want to go.
We like Jimmy Buffett, which is why we saw it. But, I was expecting to hear songs. No, you hear like a line or two of a song, and then they stop, and then they go to something else. I was wanting more music and less musical.
Yeah. No, it's when I was younger, I saw West Side Story and on Broadway.
Switchblades and songs.
Yeah. They're kind of fight, dancing, singing. I'm like, that's not realistic at all. I saw Phantom of the Opera in London. One of those 400-year-old places.
Yeah.
It was nice. It was neat, but I can do without anything that has to do with the musical. I'd rather go to a football game, eat pizza.
The original Phantom of the Opera was awesome, the movie. I tried to see the musical that came out on TV, 10, 15 years ago.
It was kind of strange.
We didn't make it through it.
I watched that. What's it, Agent Orange, or what was that? Clockwork Orange?
Yeah, that was
weird
another tough one. Yeah.
That was a weird movie.
It was.
Yeah, I can't do the weird movies anymore. I'll stick with Game of Thrones, stuff like that. Well, we went to New York for a reason. Besides, I saw my son, who's a professor there, 32-year-old professor, up in the city of New York college system.
He wore your shoes off, didn't he?
Oh, I think we walked about, 8, 10 miles a day, and holy moly, I'm not built for that.
Especially in sandals.
Yeah, don't wear flip-flops when you're going to walk 8 miles, I'm just saying. It's not a good thing.
But we were fortunate enough to go. We went for a closing bell ceremony at the New York Stock Exchange, and it's a bucket list thing. It was a lot of fun. The stock exchange, huge, tall building, and MSNBC was there with their announcers. But it's not as big as you think. The balcony where the bell is, it looks like you got a camera view that you're 50 yards back. I mean, it's like 5 feet away from the booth from MSNBC. The only way you can get on that little balcony is the doors slide open from behind, and then these 8 people are crowded on this balcony, and the doors shut. It's nothing like you see on TV.
No. Well, back when we got this, we've been in this business 30-something years each. We had this business. It was different. They didn't have electronic trading and all that kind of stuff.
Right.
And it's crazy. People throwing papers. They got laptops hanging off their necks. Different quote systems are running different tickets. You got to have different jackets for different stuff.
Yeah.
So it was a whole huge thing. And now it's mostly electronic. It's quiet in there. I didn't see anybody running, throwing tickets, doing it. And the market the day we were there was down pretty hard.
Quite a bit. It came back some. It ended up down 360
yeah, so it was down pretty hard.
Yeah.
And there's still nobody yelling, screaming, throwing, there's no tickets on the floor. It's a different world now. When you got 24-hour trading, overnight trading, there's everything is just different now. Used to be it had to be an auction thing. Right. It was an auction. So what do you do with an auction? You yell out prices. Now it's all done electronically.
Buyers, sellers,
so
market makers. There's several different models to do that.
The second part of our trip was to listen to some legendary economists.
Both Yale professors.
That's right, both Yale professors. One is Robert Shiller. He's also a Nobel Prize winner. And the other was Roger Ibbotson. Shiller has the PE ratio, which is the forward-looking PE ratio that uses the average 10-year earnings to smooth things out. Very respected. Like I said, he won the Nobel Prize for that. So Roger Ibbotson was the Ibbotson charts, those charts that every brokerage firm in the world had. When you walk into a brokerage firm, you see, okay, stocks, let's say bonds, you put in $1 in the last 100 years, since 1926 when they're doing it.
From the very beginning, and he's the grandfather or the father of.
$40 a dollar. You put it in treasury bills, it was like $12, $15. You put it in stocks, it was $5,746.
It's funny to watch them put the formulas up and explain it. we appreciate what they've done, and it's 100 years worth of material, right? They've got to synthesize down to a result. But they talked about getting their data from old records, paper records, and the way they had to calculate it, and then the quantum mathematics that's involved, and the spreadsheets, and the things to watch for, and the way that people can make their statistics subjective by eliminating. They talked about running data if you're looking at a stock or something, and sometimes they eliminate stocks like Enron,
right?
Or they eliminate ones that are no longer around, assuming that it's called survivor testing. And there's all sorts of things that people do. So when you get statistics, easy for me to say, you got to be careful and make sure that they're doing things right.
Since Enron is not in the exchange anymore, they'll use that. They'll just take it out.
Surviving stocks.
But it caused the whole market to go down. So you cannot take it out. So they use actual numbers. It was interesting to me back in the 1800s, where they didn't have stock prices weren't written down.
That's right.
They used shipping records.
That's right.
Like when the ships came in. For
how much came in.
Yeah, how much came in going out. But that's for some guys that, everybody knows I'm a big numbers guy. That's too much for me. These are economists that are, that's all they do. And they have a research team of, I bet you they had their grad students working 20 hours a day for years on this stuff. But we're looking at all those different things. Remember the Shiller PE ratio? We talked about it probably a couple weeks ago.
We talk about it a lot. We use it.
Right. Shiller PE ratio now around 32. Anytime it's reached 30 in history, the preceding 15-year return has never been more than 2% a year. I think it's 2.4, 2.1% a year. The best return ever. Now, the preceding returns never lost either, but it's like 0.6% a year. I think the average is like 1.2. And people don't understand that, because what happens is human nature. What do? Everything goes up. Last year, 2017, the stock market made, 20-something%? What do people do? Do they lock in that profit?
Nope.
Do they put in stuff that wasn't in the market into there?
When are they the most comfortable selling their stock? The price they paid. If it's down, they're going to hold it till it comes back. Right. And if it's up, it's going up forever. Right. They're not getting out of it.
Right. Remember analysis paralysis. We've talked about this before. Sometimes if you get in stocks, if you get emotions, even the people, they were talking about, even economists, we all know what we're supposed to do. The last time the economists put all their portfolios together, not one of them was even close to the others. And each one said, yeah, I know I'm supposed to do this, but I didn't. I'm supposed to diversify more, but I didn't. So even the guys that are the biggest academics in the world have not accurately done their portfolios because of human nature.
And he had one good comment. He has several good comments, but the one comment I picked up on, he said, investors do better, make better decisions with an advisor.
Right. It's a perspective thing. Okay? But people, like I said, it's analysis paralysis, because if a stock's going up, if something's going up 25%, let's say it's your 401k, do you feel motivated to make a bunch of change? Let's put it on CDs paying 1%. Does that make any sense to you? No. Does it make sense to maybe put some more in stocks? Right? Yes, but you got to look at the other side. It's gone up 9 years in a row. It takes 30 years to get your money back by buying these companies. The price is way out of whack. Now, some people would argue that, no, the tax cuts, Trump's agenda will get the stock market going longer. Numbers will always eventually come to, for either the earnings are going to come up a lot, or the price has to come down.
They talked a lot about investor behavior, which is what you're talking about. They talked about neurosciences and how deep-seated things are, and it causes us to make more decisions because we're too close to the decision.
So think about it. The market's gone up 9 years in a row. It's never gone up 8 or 9 in a row, so we've been in new territory for a couple of years, right? So it's gone up these couple of years. Where do you think the largest inflow of cash came into the market in the last 10 years? Last year. Because even though you're buying at the top, that's when people feel comfortable. We've been doing this for 30 years.
And what happened in January after they got in?
Look at 2 years ago. People are still worried about stocks. No. But after the last 2 years, 90% of people, I think I need to take more risk. Even though they're 5 or 6 years older and they already had too much risk. Oh, I think I need to take more. I don't need that much more safe. I have a good feeling about the economy. Even though the numbers might not say that. I'm one of those guys, I'm very pragmatic. I look at everything. If you keep rebalancing your portfolio, if you use the rules that everybody knows, even though it's difficult, because even the economists admitted sometimes they
counterintuitive.
can't do
I
it.
got to sell my winners and I got to buy losers to rebalance.
Right.
Right?
So, but think about it. Let's say you were in the 90s. Remember, everything was going up, tech stocks going crazy, right? If you'd have rebalanced that portfolio, let's say you started with 10% tech stocks, because tech stocks were making 60, 70% a year for many years, and blue chips were making 10 or 15.
So you had 100,000 in tech and you had 900,000 in blue chips.
Right. Now it's just the opposite. You got almost all of it in tech stocks, and people, remember, the market always comes back. But how long did it take tech stocks to come back from that low in 2002? Yeah, it's like 15 years or something.
Yep.
The S&P 500 rebounded in 5 or 6 years, but the actual NASDAQ, which almost all those stocks were, it took 15 years. So if you're the lesson here is if you're 30 years old, go ahead, you can do it, you can withstand that. But what if you're 65 years old? You're 60 years old. What if you have to go through a 15-year correction right now? How's your portfolio going to do? There's the news this morning. Actually, it wasn't this morning. It was Wednesday or Thursday of the week. And it said, coming retirement crisis. The market will cause a retirement crisis of proportions have never seen before. Because what's happening is baby boomers like us are retiring. This is the biggest amount of retirees ever.
And that's why we talked about not using the stocks for your income. Because if you're withdrawing, let's say in 08, right, you had $1 million in your stock account, you're using that to generate, you're drawing $50,000 a year off of it, and it goes down 30%. Now you've got $700,000. You're still going to draw
minus the 50 you need.
You're still going to draw $50,000 a year off that. It's just you almost can't recover.
Right. It's called the sequence of returns risk.
What he said.
You have to be cognizant of the sequence of returns risk. That's the one that Ken Fisher doesn't understand. Oh, they do understand because I saw it in the brochure. But they basically said if you take out more than 3-4% of your money, you're going broke.
Now, I know Ken Fisher says he'd rather burn in hell than buy an annuity. Does he know that there's some Nobel Prize winners that really believe that right now fixed annuities are better in your portfolio than bonds because bond rates are so low and we're coming into a raising interest rate environment?
What you got to do is don't listen to the anti-annuity people and don't listen to the pro-annuity people either, because they're just trying to sell you something else. They're either trying to sell you an annuity or they're trying to sell you their stock program.
He does have it right about you want to have a fiduciary.
Yeah. But what you got is all that kind of stuff means nothing. What they'll say is you pay more fees here. There's nothing over time. There's nothing pays more than managed money. What they do and what we do as well.
Yep.
I'm not crapping on managed money. Every advisor does it. Most advisors do it. There's still a lot of them out there that do commission-based securities. Commission-based securities is kind of a dead art. I don't even call it an art, but used to be, remember you bought a mutual fund, you paid a 5% load? Well, very few people do that anymore.
We talked about it before. If you were trading your account a lot, you didn't want to go on a transaction base, right? Then paying a commission is fine. But if you're not trading a lot, if you're a buy and hold,
you're paying for nothing, right?
That's right.
You're paying just to hold everything.
Then it's a transaction base. You're going to make one transaction, you're going to hold.
And that's what we've always taught you here on the Common Sense Investing Show, is it just depends on what kind of system it is. Like our fee-based is tactical. Tactical is not strategic. Okay, strategic is I make a strategy, I stick to this 60-40 portfolio. Now I can change some components of the 40% of the 60, but it's always going to be 60% stocks, 40% bonds.
And it's always going to change.
That's right.
Within the portfolio.
That's right. No matter what happens.
Within reason.
I don't care if stocks and bonds are crashing. You legally have to always be 60-40 in that program. And that's what most of these programs, your Fishers, your Market, all that stuff, and there's nothing wrong with it. It's just called strategic. And strategic wins in a bull market every time.
That's right.
We're more of a tactical person. In other words, I think the market is overvalued. I want to ride it up. If it keeps going up, keep me in. But if it starts turning, pull me out. So ours is tactically unconstrained. That's our managed accounts at Fidelity. In other words, it's in every sector of the S&P. If the S&P keeps going up, every sector, it stays in it all. If any sector goes below its moving average, it automatically removes that sector. And it can be 100% cash at all time, anytime. And so in 08, it was all cash. All these things there's going to go cash because if both of them are crashing, now why would bonds crash? Bonds have crashed because interest rates going up.
That's right.
So we got interest rates going up, bonds crashing. Trust me, 90% of portfolios that have bonds in them have high yield bonds. Used to be called junk bonds. Okay? So they've got bonds. Those are the ones that get hit the worst. Junk bonds get destroyed. You could lose 20, 30% on a junk bond selling it, 5 years early. And
high yield bonds, don't you mean?
Yeah.
The new term.
What they figured out is junk's hard to sell.
Yes.
High yield, everybody wants that.
That's
it's
right.
the exact same thing.
But one of the things, and again, it goes back to behavioral stuff and to human nature, there's a lot of things that take a slow, gradual approach. Tactical may do that. It doesn't make 20% a year like we did last year, like the S&P did. It may have made 6 or 7, but it also made 6 or 7 when everyone else was losing 30%. But you're in that, you're getting 6 or 7%, the market's up 20%, you're wondering where's my 20%, and it's human nature to want to move, but you've got to measure twice, cut once, and stay the course.
There's a lot of these volatility control indexes. What's happened is index annuities hit the seed about 1995. They're just a variation of fixed annuities that's been around 100 years. What they did was, instead of just paying you interest like a bank, from a treasury rate or whatever, they're paying you interest based on an index. They'll buy an option on an index. The result is you have no market risk, but you can participate if the market goes up. Well, what they've done is the problem with the rub with the index annuities, obviously no losses in unlimited gain sounds good, right? Well, it was limited. Well, it had caps on it.
And I think the problem is a lot of the insurance-only guys sold them as a market substitute.
That's right.
You can make only up years, never down years.
Right.
You know the commercials.
Right.
You've heard them. You got a floor. They're not made to replace the stock market. You still need to have your inflation edge.
Right. What they're made to replace is bonds.
That's right.
Your fixed income piece.
And they do a real good job.
Remember your rules. Whatever your age is, that's how much fixed income you should have or safe. Think about it. If you're 80, should you have 20% at risk or 20% safe?
That's right.
That's
rhetorical, right?
Right. Obviously, the older you get is more. Now, you can adjust that, 10% or so. But I'm telling you, I see it every day. You don't understand, Vic. I'm the greatest trader in the world. And I've got 90% stocks, always have, always will, never lost. I'm like, you show me that portfolio that's never lost. I know the market, S&P 500 made 5.27 the last 18 years. That's with no fees, no loads. Not even 5% of professional advisors beat it.
Ever.
So you show me that you beat it. I go, no, you don't understand. I go, doubling your money was like 3%. I go, or actually it was
in 20
4%.
years or something. Yeah.
I go, no, it's not. No, well, or they'll segment it. No, this investment account did this. My overall didn't do as much, but I didn't have any risk. We're talking about overall.
In 401ks, people don't know. They got NAVs, right, instead of fees, so it's priced in. They don't know what their fees are. They're adding X amount every month. Right. They really don't know how their account did. It's going up. They're adding every month.
What the two Yale professors, both big-time economists. Remember, Roger Evison was the biggest pro-stock guy on the planet. Still is.
Yep.
Still is. He's the one that showed you nothing beats stocks long-term. But they are extremely concerned because as people age, they need to and have to de-risk their portfolios. And the traditional way to de-risk a portfolio is to put it in bonds. The problem with bonds, when interest rates go up, bonds go down. And so you might have if you got a mix of investment grade and...
Now would be a good time to sell bonds, I'm just saying.
Well, you've got a range. Like the best you can make is maybe 3%. But what can you lose? If you're in a bond fund, it's unlimited, but let's be reasonable. 10, 20%? So put it on a scale. All right, I can lose 20%. It's impossible to make more than 3 or 4. Impossible. So you got a negative 20 to a positive 3 or 4. That's not great. Historically, bonds have 5, 6, 7% a year.
We've talked about the efficient frontier. If you put that on, the upside of 3 and the risk of 20 is terrible.
So what they did was, it's a white paper. We can send it. Okay, it said consider the alternatives by Roger Evison with Robert Schiller, providing information, also agreeing with it 100%, but saying bonds have real issues. But people can't not de-risk their portfolio. If they put it in CDs, what's the average 5-year CD? 1%? That can't be good, right? So they said, what are we going to do? We need something that still provides the safety and security, but we need a return better than 1% because then we got half our money losing to inflation. Even crappy 2 or 3% inflation, we're losing a lot of money here. And so they put an uncapped fixed index annuity into that break. Now, this is different than some of the other ones. Some of them are geared towards income, long-term care. These are geared towards growth. No caps on the earnings.
And one of the ones that Ibison came up with, and these guys are sharp as you can imagine, but just to hear them talk for an hour was just marvelous. But everyone likes, again, we're talking about the way you invest, right? Your behavior. Everyone likes the hot stuff. Everyone likes Google and the Facebook, and Netflix did so well, and Disney, and all of those. They're using the less popular stocks, a complete group, a complete indice of unfamiliar stocks, if you will. And they grow better because they don't have the influx and the shorts and all the things that fight the real popular
The line
buzzy
looks like
deals.
you'll end up about the same spot.
Well,
except
without the
line
fluctuation.
is just smooth.
That's right.
It doesn't go down 50% like the market has in the last 20 years.
It's smooth, and that's what they were trying to do, is smooth it out.
But they put them in there, and remember, index annuities have no interest rate risk. So if interest rates go down, they don't lose like a bond would. Plus, instead of having this negative 20 to a positive 3
That's right.
in the bonds, that's all you're going to get, maybe 4. All right? They have 0, because you can't lose, 0 to 20.
Which looks great on the Efficient Frontier chart.
So think
Huge.
about that. You have a bond portfolio that is negative 20 to a positive 3 or 4, or just 0 to a positive 20. When you put those numbers in, you lowered your risk on your portfolio because it has no interest rate risk or market risk. So you eliminated on your safe piece. You not only de-risked the portfolio, you eliminated the market risk of the portfolio, and your returns have gotten a lot better. The average returns on some of those are between 5 and 8% a year. 5 and 8% a year on something safe. Think about it. CDs have averaged less than 2% the last 15 years or so. Bonds have averaged 3 to 4. CDs have averaged about 1.5. You know, there's not much. Money markets, what are they? 0.1, 0.2.
Yeah.
And so
Unless
5
you
to
get
7 is not bad.
Right. That's right.
And so they took this white paper and they said, okay, what if interest rates are going down? Are they still good? What if they're going up? And they'll give you examples like if they go up 1%, 2%, 3%. And by the way, they've already gone up, what, 1.5, something like that, and they're supposed to go up another 1 or 2. So it's right in the wheelhouse. And it shows you exactly what that kind of portfolio would look at versus a traditional stock and bond portfolio. We can send that to you. There's no charge, no obligation. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Remember, there's old shows on there.
Yep.
There's some videos. There's some white papers that you can get on there. This one is not on the white paper, so you got to call us or send us a message.
And remember, we're real big on the 3-bucket strategy. So this isn't to replace a bucket. This isn't where you want all of your money. You want to make sure you have the liquidity. We always talk about it. It's expensive because you don't earn much on that. It used to be, 3 to 6 months worth of bills. Now it's a year plus, and as you get into retirement, probably a little more heavily weighted.
Yeah, if you're 30 years old, 3 to 6 months is fine.
Yeah, well, you get
enough reserves in cash.
But then you want your income bucket. It's real easy. The hardest thing to come up with probably is how much money you're going to need in retirement. But call us. We're more than happy to help you figure that out, figure out what you've got coming in, and we can show you each and every year through retirement, what your burn rate will be, for lack of a better term. And then the appropriate amount in stocks. You have to have that. It's an inflation hedge. We use Fidelity as a base and have some very good programs with them as well.
This is a common thing. Less than 10% of individuals, investors, have a written retirement plan. A lot of them think they do. That's about another 10, 15, 20%.
Or they have them. They just don't implement them.
The most popular one in America is the worst one I've ever seen. Okay? It will tell you that with the amount of money you saved.
You talking about Monte Carlo?
No. It's got a Monte Carlo simulation in it.
Right.
With the amount of money you saved, if the market is average return, you're going to get this. Above average return, you're getting this. At below average, you're getting this. And so you're like, well, heck, below average
is what?
It looks a little low, but, I think I can live with it. The problem is the market's made half of the average this century. So you're already way below average, right? So they're not even illustrating what has actually happened, much less stress testing your portfolio. What if it gets worse? Because everybody, this is sales. Let's not sugarcoat it. I know we're all financial advisors, but it's sales. What's the easiest way to make a sale, guy? Tell them what they want to hear, right? No, you're going to be fine as long as you stay with us. Stay the course. Stay there, and we'll reallocate or show you if this money manager's been doing this for 1,000 years of combined experience. They didn't tell you there's 1,000 different ones at 1 year each. But they say stay the course. Keep doing what you're doing, or make small adjustments. That's an easy sale.
And they usually have the statistics to back it up because they're easy to pull different statistics.
Oh, yeah. But the hard stuff is, hey, you got a potential issue here. If we just plug in the actual returns, which 90%, I said 90 to 95% of professional money managers did not beat that 5.27% a year figure.
And keep in mind, if you use the average number that all wirehouse brokers use, an average rate of return for the stock market of 10%, if you've done any saving at all, you'll be fine. 10% is a big number. The problem is you don't get that. We talk about it a lot. Half of that's yield, half of that was dividends. You're not getting 5% in dividends anymore.
You just have to stress test the portfolio. If something doesn't come through, in other words, stocks don't perform as you expected, are you going to be eating cat food?
What are you going to do?
You got to make sure, because I'm telling you, you got to make your portfolio bulletproof. In other words, I don't care what happens to the economy. I don't care if North Korea goes crazy and starts slapping around South Korea. All of this stuff, I'm still not going to eat cat food when I'm 80. You got to go through all those different gyrations. Then you have a basis for retirement. Because these phantom deals, average return, below average. Because think about it, what do you think they're using for below average? Maybe 20% less than average, right?
7%.
So they're using 7-8%.
Great number.
Well, that's still 50% higher than it's actually performed. So this tells me absolutely nothing. I had a guy with about $5 million, only needs out 100-something grand a year. And they said, oh, if you make 10%, no, you need more than that. There's a lot of income. As long as you make 10% a year, you're fine. I go, you didn't need a retirement plan for that. I could have told you that before you walked in here. So you got $5 million, 10% a year is $500,000 a year. You're not spending about $250, $300. He goes, that's right, I'm perfectly fine. I'm like, what if it doesn't make anything? Spend $400,000 a year. Tell me how long it lasts. Out of $5 million.
Down. That's right.
You got about 12 years, unless it goes down once. All right, you can't do that. You've got to run the real numbers. That's what we offer, no cost, no obligation. What we'll throw in as well is a Social Security optimizer. There's like 1,100 ways to take Social Security, believe it or not. It's something crazy number. Some of the stuff they got rid of with this last tax reform thing, but most of it they didn't. Is it better to wait? Is it better to do it? 90% of people take Social Security early. You'd think it'd be the opposite, right? They're starting to go.
Yeah. They're afraid it's not going to be there.
Bird in the hand. It's not going to be there. No way it's going to be there. Another one complains, it's our money, blah, blah. It's kind of true, and it's kind of not true.
Social Security, in reality, is probably one of the greatest returns on your investment in life.
Look at all you got to do.
Think how much you put in and how much you get out.
Right. Go to your SSA.gov. Go in there, type in, and create an account, and look at your thing. Look at your lifetime you put in there. And you'll see a couple $100,000. They're going to give you $3,000 a month for life.
Oh, can I do that again?
Yeah. So, yes, it is partly the money you put in. But it'd be disingenuous to say, well, they're messing with our money, blah, blah. It is a lot of a government giveaway. Now I'm saying they shouldn't.
Unless they means test it before I need it. Now, that would be different.
So, Social Security will always be there. You know, a politician would rather change parties than stay in office is what they really want, right? They'll change parties to stay in office. Kind of. That's what we saw that a bunch.
Yeah.
A lot of these ones that states that Trump won a lot. No, we're okay with it. I'm a Democrat, but we're okay. I'm like, what? So that's the kind of stuff you'll get. Social Security will be there. Your pension, that might be a different story. If your pension is not paying, once it starts paying, it's okay.
Most municipalities are underfunded. That's a whole nother deal.
That's another thing Roger Ibbotson and they were talking about is pensions are severely underfunded. There's going to be a pension crisis that will hit us like no other, and the government's going to have to bail most of it out. And so that's going to be a big issue. But remember, you get the written retirement plan. Less than 10% of people have that. Social Security optimization and the white paper by Roger Ibbotson. No cost, no obligation. Our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.